Hello and a very warm welcome to HW News with me Ali Azhar on my show where you can get your dose of the daily business and finance news that's been shaping your world. Let's get started. India is the world's fastest growing smartphone maker and every smartphone maker is looking to grab a bigger piece of this pie. Smack in the center of this battle is iPhone maker Apple. The Tim Cook-led laptop to watches maker has been in the news lately for all the wrong reasons. Central to all its recent problems lies its flagship product from which it generates nearly 2/3 of its revenue, the iPhone. The recent slump in the sales of iPhone in China has prompted Apple Incorporated to cut its revenue outlook for the first time in almost 2 decades. CEO Tim Cook downgraded sales forecast by $5 billion, sending shares of the tech giant tumbling 10% intraday in US stock markets just 3 days after New Year. Fewer than expected upgrades in the recent iPhone, weakness in China's economy, partly due to trade war concerns with the US, and supply constraints were cited as the main reason for its poor performance. Even in India, iPhone shipments are estimated to have shrunk by as much as half in 2018 compared to 2017. A prominent Hong Kong-based market research firm projected Apple India's shipments between 1.6 and 1.7 million units in 2018, down from 3.2 million units in 2017. Apple is finding it hard to compete with rivals in India, such as China's OnePlus, which offer devices with better features at half or even 1/3 the price. The Central Statistics Office on Friday evening released its monthly industrial or factory output figures. It did not make for a pretty reading. These monthly figures are released 6 weeks after the reference month ends. What the number revealed was industrial output in November 2018 grew by a meager 0.5% from a year earlier, the lowest since June 2017. In October, it had grown by a healthy 8.4%. Factory output, measured by the Index of Industrial Production or IIP, measures the status of production in the industrial sector for a given period. A Reuters poll had estimated a growth of 4.1% and a Bloomberg poll had forecast a growth rate of 3.6%. A growth rate of just 0.5% managed to disappoint everybody. This figure signals a weakness in consumption and investment and is expected to translate into a weaker GDP growth in quarters to come. A low IIP number coupled with slower than expected GDP growth and benign inflation outlook may force the RBI to change its policy stance and cut interest rates going forward. From one macroeconomic indicator to another, the fiscal deficit target is an important parameter to assess how well the government budgets its revenue and expenditure. Hence, if the total expenditure is greater than total revenue, the government needs to bridge this gap by borrowing money. Being expressed as a percentage of GDP, the Modi-led BJP government had set a target for a fiscal deficit of 3.3% or 6.24 lakh crore rupees for itself for the financial year ending 31st March 2019. However, by November of 2018 itself, the fiscal deficit surpassed its target and stood at 114.8% of its full year estimate, which translates into a 7.16 lakh crore rupees deficit. Fall in GST collections, lower than expected disinvestment receipts, farm loan waivers, MSP hikes, disappointing IIP numbers, and populist spending measures adopted by the government being an election year all add to the overall expenditure and are putting further strain on the fiscal deficit. A majority of recently polled analysts and experts also believe it will be very difficult for the government to meet its target. However, Finance Minister Arun Jaitley still believes that the government can meet this target by ramping up its revenue. It is a matter of pride for the government to meet its fiscal deficit target and show that it is capable of meeting its budgeted expenditure. The Indian corporate sector has seen more than its fair share of power struggles between family members vying to gain control of their multi-million dollar and sometimes even billion-dollar empires. Famous names such as the Mafatlals, liquor and property baron Ponti Chadda, billionaire brothers Malvinder and Shivender Singh and even the Ambani brothers have slugged it out in the past to gain control of their conglomerates. The latest to come our way from the stables of corporate India is the spat between father and son duo of Gautam and Vijaypat Singhania, the owners of fabric and fashion retailers Raymond Group. Vijaypat Singhania, the 81-year-old former chairman emeritus of the billion-dollar textile empire, accuses his son of kicking him out of the board of directors of their businesses and cheating him out of an exclusive apartment in South Mumbai's Warden Road. The elder Singhania's trouble started when he gifted 37% stake in his company to his son Gautam in 2015, which he now claims was done in a moment of stupidity. This public tussle has father accusing his son of occupying 12 floors of JK House in one of South Mumbai's most posh locations for parking his sports cars. He goes on to say that the market price of the flats are rupees 1.35 lakh per square foot, making 12 floors worth 840 crore rupees. Gautam Singhania, on the other hand, denies any wrongdoing, saying his father flouted regulatory requirements, made bad decisions and mismanaged the company, and went on to say that he had a duty to the Raymond Group and that he was simply doing his job in the best interest of the company. This tussle is now a case in the Bombay High Court. Thank you for watching HW News. This is me signing off. Have a great day.
If you like this video, please share it, and we would love to hear your comments in the comments section down here. Also, please do like our Facebook page and follow us on Twitter to get minute-to-minute news updates. For more such shows and videos, well, subscribe to our YouTube channel.